Right now, Wall Street's toasting a soft landing, but the services sector stall just yanked the parachute. The risk is your job could be next. And right now, for 138 million Americans, they're starting to panic, and for good reason. Because if we don't have a blockbuster holiday season, if the Fed rate cuts don't work, we're headed for a hard landing. And if you think this is an outlier, I want you to think back to the great financial crisis, because what happened then? Manufacturing led the services sector into a downturn. And what was it led by? A buildup in inventory, a decline in exports, and rising prices. Sound familiar? Because back then, 4.6 million Americans lost their jobs, and the parallels right now are frightening. As the U.S. services gauge falls on the weakest business activity since 2020. And this is a huge red flag for the economy, because the services sector accounts for about 70% of GDP. That's 138 million jobs tied to the services sector. And this affects 1 out of every 3 Americans. And I want you to think, because even a slight pullback against 138 million jobs will affect millions of Americans. Now think back, it wasn't just a couple years ago that we heard that the services sector was strong and robust. It was going to pull the economy out of the slump as Americans were eager to spend. But what happened? Just the opposite. I was warning that where manufacturing led, well, services would follow. And sure enough, that's exactly what we've seen. Now, the problem is for the services sector, they derive about 10 to 15% of their business from the manufacturing sector. And this is a major problem, because when manufacturers enter a contraction, and that's exactly what we're seeing right now in the data, will affect service providers in a major way, and that means it's going to affect a lot of jobs. Let's turn to the Institute for Supply Management's Index of Services. It dropped 2 points to 50, and my friends, that level indicates stagnation. It means we're not expanding, we're not contracting. But for the services sector, anything under 53 actually is a contraction, even though the number only printed 50. The Business Activity Index, which is similar to the ISM's factory output gauge, fell more than 5 points and entered a contraction territory for the first time since May of 2020. So we have to go all the way back to the pandemic to find out when things were this bad. So again, you think about the parallels to the GFC. Right now, 1 out of every 3 Americans are tied to the services sector. Again, 138 million. So you think about just even the smallest pullback, it's going to have a huge impact. And again, you think about what's going on in the real economy right now. Inflation is still rising, albeit at a relatively slow pace compared to what it was over the last couple of years, but it's still rising. And for right now, households, if you think about their financial situation, a slowdown in the services sector means they're going to see their hours get cut. Maybe they're going to lose their job. And that less income is going to feed right back into the real economy, leading to a further slowdown in an economy that's already headed the wrong direction. What you can see right now, the risks are high that if things don't change and quick, we're headed right into a recession. Because if you look at the trend, and let's take a look, because you see the services sector was in deceleration going all the way back to October of 2024, and that ran right into March of 2025. Now, since then, it's been in stagnation, meaning it's not growing, it's not contracting. But again, if you think about the services sector it needs to be over 53 to really denote an expansion. We're not seeing that. Now, the problem here, and broadly speaking, is there are further declines in the manufacturing sector. And I want you to think about all the data we've looked at recently. It says there are going to be further declines. It's going to have a huge impact on the services sector, because again, all the money spent by manufacturing into the service sector is going to be missed by a lot of these service providers, and in a big way. And what we're facing here is this recent plateau in the services sector is threatening to enter another decline. And this is exactly what workers have been worried about. We're hearing this in the sentiment surveys, that they're worried about their jobs, they're worried about their incomes, and you could see for good reasons, because these echoes of 2008, my friends, they're not a coincidence. Let's trace this sinking lifeboat and just see how far it can go. Let's start with new orders. And this is the lifeblood of every business, because you need new orders, not just to keep your business running, but right now to deal with rising costs. And this is a big issue for a lot of employers, is they need a lot more new business and they're just not getting it. For employees, what it means is more hours, more pay. They're not seeing that either. I want to give you a quick update on that trade on SMH that I showed you yesterday. Let's check this out. It's now up 13.8%. Again, we make trading so easy for our subscribers because they don't have to sit in front of their computer all day. We give them risk control levels. In fact, yesterday we updated it. In fact, I have a major announcement coming soon. Right now, I'm integrating our CTA Timer Pro into the optimization engine, and it's unlike any other strategy. It blows the doors off of everything. Now, you need to get on this program before the price goes up. If you've been waiting, time's running out. Grab those links in the description below. Use a coupon code for your free 30-day trial because the new Metre strategy with the CTA integration is going to change things once again. Stay tuned to the end of the show for more information. And take a look at this. Top industries reporting a decrease in new orders for the month of September. Real estate, rental and leasing, construction. You know, we've been talking about real estate recently, how a new construction, they're pulling back due to too much inventory. And what about the resale market? It's been impacted by a slowing economy and high interest rates. What did I tell you was going to happen? There was going to be a cutback in employment. It's exactly what we're seeing right here. Now, as we look at the data, we can see August was a complete outlier, even though a lot of experts got excited about it. What we're facing is continued stagnation, the risk if it doesn't turn around. And that's a problem as we look at the holiday season, because what did PricewaterhouseCoopers recently say? That consumers were eyeing a 5% spending drop over last year. McKinsey notes that 25% of all consumers are already starting to cut back on their spending. So what we're seeing in the services sector here are clear indications that new orders aren't picking up. But the big problem is, it's not just new orders, it's backlogs. And what backlogs are, and that's work that's not yet complete, it's in the backlog, and certainly enough, what are we seeing? Continued contraction. Let's take a look, because what do we see here is backlogs. Again, contracting since June and at a fairly big clip. Didn't see a big drop off in September. And the risks here are very clear. If you don't have enough new business to keep your workers busy, you put it on backlogs. But when your backlogs run out, you've got a problem. And we also see it in the new export orders. They've been contracting since July. Now, this is interesting because what did we see in April and May? The global economy started to roll over, and again, now we're seeing the impact of the tariffs. So what happens when you see new orders slow down? You see backlogs continue to contract, and you see new export orders also contracting. Well, it's going to impact the labor market, and that's my fear. Again, a small pullback could affect 138 million workers. It may not lose their job, but you could see hours get cut. And yes, again, a small percentage could lose their job, and that affects millions. And what have we seen in the employment side of the services sector? A continued contraction since June. Again, look at this. You see the impact that new orders, new export orders are having on the labor market here. And again, this is exactly what I've been warning about. Again, you think if there's just 1%, that's 1.38 million Americans that could be out of work. But for everyone else that does have a job, you can see clear signs. It's going to lead to fewer hours. And again, it gets rising inflation. This is exactly what we're seeing in the sentiment surveys. Workers are complaining. My paycheck's not going as far. So you look at the holiday season and you can see why spending is likely to decrease and why there's so much hope being pinned on those Fed rate cuts. Because if we turn to inventories, we can see that there's no real change here. We're facing the fact that inventory levels up until this last month were rising. And look at some of these comments. You see they're maintaining higher inventories of items purchased pre-tariffs, and with mostly falling or expected falling commodity prices, there's a reluctance to overstock, especially without a real fear of tariff-inflicted price increases. So what we're facing here is a supply chain that has too much inventory on the services side. But it's not just services, it's manufacturing as well. And so what we're seeing is disinflation starting to creep into the input side. And a lot of service providers are saying, look, this isn't really an incentive to keep purchasing. So what happens when you don't have enough inventory? You see businesses starting to stock up, and that could turn an economy around. But when you take a look at inventory sentiment, what we're seeing here is respondents feel their company's inventory levels are too high when correlated to business requirements. And what this is telling us is demand is dropping off, because you can see the inventory sentiment numbers, 57, 53, 55, is all saying, look, we have too much of the stuff. But that's not the real issue here, because the real issue is demand is dropping off at a much faster pace. And this is something that I've really been concerned about. And if demand drops off, you don't need more inventory. If you don't need more inventory, you don't need the workers. Next thing you know, your backlogs get cleared out, and that's going to lead lead to a lot of Americans hitting the unemployment line. Now, on top of that, it's also going to lead to further disinflation. And again, for those that do get to keep their job, they're going to see their hours get cut. Because as we talk about those parallels to 2008, you can see very clearly the relationships here are strong. This is the exact same setup we saw then. But we also saw prices rising, and look at this, prices paid. They're continuing to rise since June. So you think about this, with slowing sales and too much inventory and insufficient work, again, hours are going to continue to get cut for those 138 million Americans tied to the services sector, and that's the best case scenario here. And right now, based on what we're seeing in this services report here from the ISM, there's no indication this will change unless demand turns around. But for the moment, what it appears is demand is dropping and supply is coming down to match it. And that is why we're facing potentially the next leg down in the economy. And that's why a services slowdown is a huge red flag, my friends, because think back to 2008. 4.6 million Americans lost their job, and that happened without warning. And for the 138 million that are currently employed in the services sector, this is a major problem. This is a dire warning of an impending recession. And this is why we need a blockbuster holiday season. Again, the problem is consumers are saying they're going to spend less. Now, the question is, will they, or will they come out and spend strongly? We don't know. Or maybe it's the Fed rate cuts, they'll do some magic. But if neither of those work, that is a major problem, because what we're facing, again, is the same thing that happened in the financial crisis. So right now, as you look to the stock market, it's giving you the impression that everything's okay. But when you look at the finances of the average American household, they're saying it's anything but. And by year end, if things don't turn around, if we don't get a lot of holiday spending, if the rate cuts don't work, you could see millions of Americans could be hitting the unemployment line, while the rest face massive cuts in their hours. So here's what you need to know. If you're already seeing declines in your hours, or you're concerned that you could lose your job, what do you need to do? Start stocking up on essentials. Look for things in your budget you can cut back on. And if you don't have a budget, it's one of the most powerful financial tools you can have. Save up some cash. Look at your investment allocation, because if indeed we're heading into a recession, you want to tilt your portfolio into the defensives. If you like this video, if it hit home with you, smash the like button, subscribe for more. Now, right now, I'm changing the game when it comes to trading, and you can get in on this, because what we're doing is we're taking all of these strategies out on the market, we're optimizing them on a per security basis, and then identifying their strengths and weaknesses and creating an ultimate meta strategy. Let's take a look at what an optimized strategy looks like. This is from our meta strategy. It's not the enhanced version that we're running now that's even better, and not the one that's coming soon with the CTA integration. Check this 2-year back test on the SPY. Total return 71%, beating buy and hold, win rate over 66% with 69 trades, max drawdown right around 7.5%. Now let me show you this against an unoptimized strategy. This run by my buddy Jay Bravo. He says, look, one size fits all, but the reality is he also will tell you that you have to use a lot of other signals with this. You've got to sit in front of your computer all day to trade, but not with mine. And look at the difference. Total return 51%, missing buy and hold, win rate 51% with half the number of trades and the same drawdown. Now let's talk about how you get the meta strategy in all of these trades. You got to sign up for one of my reports. Now, our best report, that's our CTA Timer Pro. We trade against machine positioning, and we're making some major upgrades to this that's going to, again, put more money in your pocket when it comes to trading. But maybe you don't want to trade against machine positioning. Well, we have a Momentum Timer Pro. We look at those tactical indicators and the trend. We pair those all together, and then again, it's called our Momentum Timer Pro report. But what we've done is we've combined right now 10 professional trading strategies into a single intelligent signal generator, generating a massive number of signals. And again, we have multi-strategy consensus, but what I've done is I've optimized it for swing trading with the highest potential 10-day forward-looking returns. Nobody else has done this. Again, we show you how to get in, get out, and put money right in your pocket. Now, again, you've got to sign up for one of those reports, and of course, you get all of the signals from those reports on top of those meta strategy trades. You get my opinion on the best trades. We give you risk control levels, full tracking of all our open trades in return, a weekly update, and here's the best part. Whether you're brand new to trading or whether you're buying other subscriptions, you can compare us for 30 days, and you're going to see at the end, we stand as the best. How do you do that? Grab those links in the description below and use a coupon code for your free 30-day trial. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.